So the biggest risk has got to be Trump, I think, President Trump, and what he's doing around the tariffs, albeit the first order impact from tariffs, if you look at what the majority of economists have said, or what I've read in any case, the first order GDP impacts to global growth are likely 0.5 to a maximum of 0.6 of global GDP, and that's not a small figure, but it's not sufficient to derail what was previously 3.5% global GDP growth, so it sort of brings it back to a still quite solid 3%. But it's really the second order or third order impacts from those tariffs, and I'm talking about things like business confidence. You know, do the imposition of these tariffs have a significant impact on the confidence of companies in the US and China, and indeed therefore the rest of the world? And does that change their investment and hiring plans and lead to a synchronised slowdown? That's obviously what the market's most concerned about, and I think is one of the biggest risks for not just Aussie equities but global equities in the year ahead. So typically, or over the past 2 years in any case, we've been relatively optimistic on equity markets and indeed global growth, and that hasn't changed too much, even despite what the likes of the Americans and President Trump are doing at the moment around trade tariffs and sanctioning their major trading partners, which is clearly going to be a bit of an impost to GDP. So our portfolios are still positioned for relatively strong, albeit decelerating, global economic growth and relatively stable domestic or Australian economic growth. There's not really many signs domestically that the economy's on a tear. Certainly the consumer continues to be under the pump somewhat, albeit domestic infrastructure spending has been picking up and still looks solid for the next couple of years. So broadly our portfolios are still positively positioned for rising equity markets.